Welcome to today's explainer. I am so glad you're here. Okay, let's dive right into this. I want you to think of me as your mentor today, all right? Consider this our one-on-one strategy session. We're going to talk about something that happens to absolutely everyone who decides to step into the world of investing. Yet, for some reason, it's the one thing that trips almost everyone up. We're talking about economic downturns, market crashes. Those terrifying moments when the charts seem to just point straight down. But here's the thing. Historically, massive amounts of wealth change hands during these exact downturns. Understanding how to navigate a falling market? Well, that's exactly what separates those who struggle from those who capture that transfer and build lasting generational wealth. So, put yourself in this scenario. When the economy crashes, what do you actually do? It's a heavy question, isn't it? And listen, I want to validate exactly what you're probably feeling right now, just thinking about it. For most people, especially if you're a new investor, it is incredibly daunting when markets fall. You open up your portfolio and bam, all you see are red numbers. The news is just blaring nonstop about economic doom, your account balance is shrinking day by day, and your very real, very human instinct is screaming at you that something is terribly wrong. It's a completely natural reaction to feel that knot of anxiety right in the pit of your stomach. And well, that anxiety leads directly to the instinct to panic and sell out of fear. This is where the average person gets completely derailed. They look at the falling market, they see those dropping numbers, and they incorrectly assume that it's all over. They try to stop the bleeding by offloading their investments out of pure panic. But here's the kicker. In doing so, they are literally locking in their losses. In fact, retail investors historically underperform the broader market by a significant margin precisely because of this behavior. Buying when times are euphoric and then selling at the absolute bottom when they just want safety. Now, what's really interesting about this slide is the stark contrast between two completely opposing mindsets. On one side, you have exactly what we just talked about, most people panicking and selling out of fear. But on the flip side, wealthy investors actually get excited. They actively look for opportunities. I really want you to let that sink in for a second. The exact same event, a market drop, produces sheer panic in one group and genuine giddy excitement in another. This is the great secret of the wealthy. They don't magically have access to different public markets than we do. They simply have an entirely different lens through which they view a downturn. As your mentor, I need you to burn this concept into your mind. Recessions create opportunities that can make fortunes. The wealthy do not view a falling market as an apocalypse. They just don't. They don't see it as the destruction of their wealth. Instead, they see it as a rare, highly calculated chance to build massive fortunes. They understand that wealth isn't necessarily made when everything is going perfectly. Wealth is accelerated during the downturns, right when everyone else is running for the exits. Let's move to and see how this builds. Because to understand how they do this, we have to completely redefine what a discount means in investing. A discount is simply when stocks, businesses, and other valuable assets become significantly cheaper during a downturn. Where the novice investor sees extreme danger and loss, the wealthy investor simply sees incredibly high-quality assets on sale. Think of a top-tier technology company or a rock-solid blue-chip stock suddenly trading for a fraction of its normal cost. The underlying value and utility of those great companies hasn't completely vanished overnight, right? But their price tag certainly has dropped. It's a fundamental shift from seeing a crisis to seeing a clearance event. Let me completely reframe this paradigm for you. Imagine your absolute favorite store in the world, the one where you literally love everything they sell. Imagine walking up to that store tomorrow and suddenly there's a giant glowing sign in the window that says everything inside is on a massive half-price clearance sale. 50% off the items you already know are incredibly valuable. So let me ask you directly, as if we were standing right outside that store right now. Would you run away or would you start buying? You certainly wouldn't sprint away from the store screaming just because the prices dropped. No way, you'd grab a shopping cart. Making this abstract financial concept of buying discounted stocks intuitive is absolutely crucial, because if you wouldn't run away from a 50% off sale on your favorite clothes or electronics, why on earth would you run away from a 50% off sale on the best businesses in the world? This brings us to the core behavioral blueprint I really want you to adopt from this explainer today. Instead of panicking, they prepare. Wealthy investors aren't caught off guard because they expect markets to fluctuate. They know winter always comes, so they don't freak out when it gets cold. They are ready for it. The key to surviving and thriving in a market crash is preparation. For a new investor, this specifically means building up an emergency fund so you aren't ever forced to sell stocks just to pay rent, and keeping dedicated cash reserves ready to deploy when those premium assets finally do go on sale. So the crucial point is this. Markets have historically recovered over time. I want to instill a deep, unwavering confidence in you right now. The reason the wealthy can confidently buy when everyone else is panicking is because they rely on the historical resilience of the market. Consider the massive drops during the 2008 financial crisis or the sudden, sharp plunge during the 2020 pandemic. Man, it felt like the end of the financial world. Yet in both cases, and indeed after every major historical downturn, the market eventually bounced back to eclipse its previous all-time highs. Knowing that recovery is an inevitable part of the cycle, that's what gives you the courage to act when everyone else is frozen. But I must warn you, and I am speaking to you now with some serious tough love. The true danger to your financial future isn't the market crash itself. The ultimate mistake is making emotional decisions during that crash. It's letting fear completely take over the driver's seat. It's that internal emotional sabotage that causes people to do the exact opposite of what they should do, selling their assets low. When you let fear win, you lock in your losses. You literally turn a temporary dip into permanent financial damage, and we don't want that for you. And this brilliantly illustrates the final golden rule of investing. On one hand, you have fear, which results in selling low, the ultimate losing strategy. On the other hand, you have patience, the wealthy investor's mindset, which is all about staying deeply focused on your long-term goals. Patience is the shield that protects you from all that daily noise. It's the understanding that a 5-year or 10-year goal is absolutely not destroyed by a 6-month downturn. Well, unless you actively choose to let fear make you hit that sell button. As we wrap up our strategy session today, I want to leave you with this: to look inward. The market will fall again. That is a certainty. It's just part of the economic cycle. So the question isn't if it will happen, but what you are going to do when it does. Next time the market falls, will you let instinct take over and panic? Or will you remember our session today, adopt the mindset of the wealthy, and prepare? The choice you make in that very moment will completely define your financial future. Think about it.